Hi everyone, welcome to the session. In this session, I'll be discussing about cash flow statement analysis. To explain this, I have selected the following question. Based on this, you are required to prepare a cash flow statement based on indirect method. So as you can see, you are given the income statement and the financial position as on 31st January 2020. Along with that, a cash book extract is also given, which means you should arrive at the carrying forward balance of $225,000. There are two ways you can prepare the cash flow statement, direct and indirect method. Regardless of the method, the cash flow statement has to be prepared based on three main activities. So the cash flow statement has three main components. What are those? The first one is the operating activities. The second one is investing activities. Third one is financing activities. So we should identify the cash flows from these different activities, these three activities. Now first of all, we'll look at what are operating activities. So operating activities means nothing but cash flows from business operation, such as cash inflows from sales, cash payments to suppliers, and also cash payments to employees for salaries, and also cash payments to rent, insurance, etc. So those categories will fall under operating activities. Then what about investing activities? So investing activities include purchases of fixed assets, sale of fixed assets, and also purchases and sale of stocks and bonds, etc. So these items will fall under investing activities. Then financing activities. The financing activities include investment made by business owners. So basically, mainly the equity owners, their contribution towards the equity, and also borrowing of funds from banks, repayment of loan and payment of dividends to the equity owners. So these items will fall under financing activities. So those are the three main activities under which we need to identify the cash inflows and cash outflows. Under both methods, we have to show cash inflows and cash outflows from these activities. The only difference between direct and indirect method is that the cash flows from operating activities. So when you identify the cash flows from operating activities under direct and indirect method, it's slightly different. So under indirect method, the operating activities will be based on net profit. You need to calculate based on the net profit. Then under direct method, operating activities cash flows will be based on the cash collection from customers, cash payments to suppliers, cash payment for administrative expenses such as employee salaries, rent, insurance, etc. So these are the major differences between the direct and indirect method when you calculate the cash flow from operating activities. In this video, I am going to focus on indirect method of preparing cash flow statement. Now let's move on to the question. So you are given the income statement, the financial position, and the extract from the cash book. So under indirect method, what you need to do is you should start from the net profit. Now in this case, from net profit of 70,000 US dollars, you should arrive at the cash book balance of 225,000. So let's have three headings: in order to calculate the cash flow statement. Now our three headings will be cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Now the cash flow from operating activities should start with the net profit. So how much is the net profit? It is 70,000 US dollars. Now this 70,000 net profit, is this the actual cash profit? It is not. As we can see, some non-cash items also included in this 70,000. So as you can see, the depreciation is also included. It's a non-cash item. And also, we prepare income statement based on accrual basis. What is an accrual basis of accounting? Under this, we record revenue when it is earned, not when it is paid by the customers. Similarly, expenses are recorded when it is incurred, not when it is paid. So basically the payment date is different from the recognition date. So therefore, this 70,000 US dollars is not actual cash profit. It's a book profit considering non-cash items as well. So hence what we need to do is we need to identify actual cash profit for cash flow statement purpose. Now let's go through the income statement along with the financial position and the cash book details to identify non-cash items. First of all, let's start with depreciation. Depreciation is a non-cash item. So it's anyway non-cash items. So therefore this item has to be, this depreciation has been deducted when arriving at a net profit of $70,000. So this 70,000 is arrived after deducting this non-cash item. So therefore, to identify the actual cash profit, you should add back. So now we have the net profit 70,000. We need to add back the depreciation of $5,000 because it's a non-cash item. Now let's look at the other items in the income statement. So first of all, we'll look at the revenue. So revenue is 600,000 US dollars. Is this the actual cash revenue, actual cash sales? It is not. Why? If you look at the cash book and the financial position, you can come to a conclusion which is not the actual cash sales. So when you look at the cash book, how much you have received from the customers? How much you have received from the customers? The cash collection is 400,000. Then you can see in the financial position, there is an accounts receivable balance of 200,000, which means out of 600,000 revenue, amount received is 400,000 and therefore 200,000 to be received from the customers. So the net profit of 70,000 includes this 200,000 revenue which is not received. Hence, what you should do to identify the actual cash profit or actual cash flows. So you should deduct this amount. You should deduct this amount from this 70,000. In other words, we can say there is an increase in accounts receivable balance. So any increase in accounts receivable will be a deduction to the net profit. So any increase in accounts receivable will be a deduction to the net profit. This we categorize it under a special heading called working capital adjustment. Since AR falls under working capital category, so we need to categorize this under working capital adjustment. So any increase in assets, accounts receivable is an asset. So any increase in assets will result in reduction in working capital. So basically this is a norm. So you should remember this. So whenever there is an increase in asset, accounts receivable or any other assets, you have to deduct it. Now, let's look at the next item in the income statement. So next item is the purchases. So do the similar test to identify whether this is an actual cash purchases or not. So if you analyze this, you will understand that this is not the actual cash outflow, because in the cash book there is a payment made to the supplier which is 300,000 US dollars, and under current liabilities in the financial position there is an accounts payable balance of 200,000. So which means out of 500,000 purchases, the company has paid only 300. So 200,000 to be paid. It's not paid. So this net profit of 70,000 is less by 200,000. So for which the company has not paid, whereas in the income statement we have deducted 200,000. So this is because of the accrual accounting. So the net profit 70,000 is less by 200,000. So what we have to do? We need to add back this 200,000 as increase in accounts payable. Increase in accounts payable under working capital. So any increase in accounts payable or liabilities will result in increase or addition to the working capital. Is that clear? Now the other item is inventory. So inventory value is 250,000. You can see this balance in the financial position, which means these inventories were not sold, so that the cash is tied up in inventory. So the company is unable to realize the cash, for which cash has already been spent or paid. So there was a cash outflow. Therefore, in order to identify the cash profit, what we should do? We should deduct this increase in inventory from the working capital. So inventory is also part of current assets, therefore it falls under working capital. So please remember, inventory is an asset. Any increase in asset will result in reduction in working capital. So you need to deduct this amount from the working capital. So next item in the income statement is administrative expenses, 275,000. So if you look at the amount in the cash book, you can see the actual amount paid is also 275,000. So therefore we can come to a conclusion, this amount is the actual amount paid. So there is no payable amount in the balance sheet. You can't see any payable amount. So therefore there is no adjustment required because this 70,000 is arrived after deducting this 275,000, which is the actual cash payment. Now based on this, what we can do is we can calculate the net cash flow from operating activities. So actually it's a net cash outflow of 175,000 US dollars. Now we are done with operating activities. Let's move on to the investing activities. Have a look at the financial position. Under non-current assets, there you can see there is a purchases of machinery worth 300,000. This amount you can see in the cash book as well. In the cash book, there is a payment of 300,000. Therefore, this amount has to be shown as an investing activity as a cash outflow. So we can show this as purchases of machinery under cash flow from investing activities. And if you look at the current assets, accounts receivables already we have considered, inventory also we have considered, the cash balance, this is what we need to arrive at. We should arrive at 225,000 after all these adjustments. Now let's move on to the equity. So under equity, you can see owner's equity is 500,000. This balance 500,000, as you can see, owner has invested an additional amount of 100,000 into the business. So therefore there is a cash inflow to the business. So this we have to show it under financing activity as owner's capital investment 100,000. Now this 500,000 consists of opening balance of 400,000. This difference of 400,000 represents the opening cash balance. This we will have to show separately in the cash flow statement at the end of the cash flow statement. So this difference has to be shown in the cash flow statement at the end. For the time being, let's take only the cash flow, only the additional cash investment 100,000 under cash flow from financing activities. Apart from that, the company has obtained a bank loan of 200,000. So as you can see under non-current liabilities, you can see 200,000. As a result of that, the company's cash flow has increased by 200,000. It's a cash inflow. So therefore in the cash flow statement under financing activities, you have to show bank loan proceeds 200,000. So finally the current liabilities in the financial position. So accounts payable, that also we have taken into account when we calculate the working capital adjustment. It's already considered. Now we have taken into account all the cash flow items under operating activities, investing activities, and cash flow from financing activities. Now let's take the net cash flow from these three activities. Now as you can see, the net cash flow from operating activities are 175,000 negative. It's a cash outflow. Then the cash flow from investing activity is also a negative 300,000. It's a cash outflow. However, the cash flow from financing activity has a positive cash flow. So 100,000 from the owner, this is the additional capital investment, and the bank loan proceeds. so which is 300,000. So if you add up $175,000 negative, $300,000 negative, plus $300,000 positive, your net cash and cash equivalent during the period will be 175,000 negative. So this is the net cash flow during the month of January. So what we need to do is we have to take the cash and cash equivalent at the beginning of the year. As I told you earlier, this 400,000 is part of the equity. So this is the opening balance. So we need to take the opening balance in the cash flow to calculate the closing balance. So when you add up 400 positive and 175 net cash flow negative, so that will be 225,000 cash and cash equivalent at the end of the year. In fact, this should be the cash and cash equivalent at the end of the period. And the opening balance also, cash and cash equivalent at the beginning of the year is 400,000. So when you make the adjustment, the balance will be 225,000, which is cash and cash equivalent at the end of the period. So as you can see, this 225,000 exactly matching with your cash book balance 225,000, which is in the financial position 225,000. So this method is known as indirect method of cash flow statement. So what we did, we took the net profit. From net profit, what we did, we adjusted the non-cash items, and also we make an adjustment to the working capital. So under working capital, we have current assets and current liabilities. So those adjustments we have done here, and based on that, we arrived at net cash flow from operating activities. Then what you need to do is you need to look at the investing activities and financing activities. So investing activities, we considered non-current assets purchases. Now in this scenario, you are given only the purchases. So therefore, we made an adjustment for the purchases of machinery. Apart from that, the financing activities consist of owner's additional investment and bank loan proceeds, the borrowing of bank loan proceeds of 200,000 and owner's additional capital investment of 100,000, which is 300,000. So what we did, we just added these three activities and we arrived at the net cash and cash equivalent during the period. To that amount, we added the cash and cash equivalent at the beginning of the period. Then we derived the closing balance, which is the cash and cash equivalent at the end of the period. I hope this is very clear to you. If you have any doubts or any clarification, what you can do is you can leave a comment. And also if you have any other topics or any concepts which bothers you, so what you can do is you can leave a comment. So I will work around the clock to make videos on those areas. So with this, I will conclude the session. I'll see you soon with another video. So until then, bye for now.